Welcome to the Trendline Gala podcast. We're looking closer today at the true cause of most avoidable financial losses, and here's the surprise.
Mm,
It isn't usually poor planning or, faulty research or even a bad prediction.
right.
It is that handful of moments when we actively choose to ignore the comprehensive plan we already made. It's the self-sabotage that happens under pressure.
That's exactly right. And for you, the learner, we are aiming for some really practical insights into the psychology of, well, high-pressure decision-making.
Okay.
This discussion is going to explain in detail why decisions that feel incredibly urgent and, logical in the moment,
Necessary, even.
absolutely necessary, why those decisions so often look completely foolish just a few hours later once the pressure's off.
Yeah.
We want to arm you with the ability to identify that precise psychological disconnect before the damage is done.
It is a classic paradox of control, isn't it?
It really is.
You can spend weeks crafting the most objective, statistically sound strategy, mapping out every contingency,
All the hard work.
and then throw all that painstaking work away in 30 seconds of panic or rage or even, overwhelming confidence.
Mm-hmm.
Let's break this down by looking at how this conflict even begins.
Okay.
So let's start by challenging that common belief system. If you ask a frustrated trader or investor why they lost money, they almost always blame something external.
Right. It's the market's fault.
It's the market, a bad news event, or maybe a flawed entry signal. They blame the plan or the market.
But here's what we know. In reality, the vast majority of financially damaging losses, the ones that, wipe out months of progress,
Yeah, the big ones.
the big ones, they happen after a comprehensive trading plan already exists. A plan that specifies exactly when to enter, exactly what position size to use, and exactly where the stop-loss levels are set.
So the blueprint is already there.
The true problem is not a lack of rules or a lack of preparation. It's the emotional override. It's that specific moment when those perfectly good rules are deliberately bypassed.
I find this fascinating because it fundamentally divides the trader into two people, right?
Totally.
You have the calm planner and then you have the panicked executor.
That's a great way to put it.
The calm planner is rational, objective, often planning strategies when the market is closed or when they're, far away from the real-time volatility.
They're in a cool state,
Yeah,
operating from a place of statistical probability and risk tolerance.
exactly.
That rational self looks at historical data and constructs boundaries based on a clear acceptance of loss as just a necessary part of the process. That plan is inherently disciplined, but the execution of the mistake, the moment the override happens, that occurs much later. And specifically, when three highly charged conditions are met at the same time.
What are those three conditions? Because I think identifying the environment of danger is half the battle.
Okay, so first, a trade is already open. This means the situation is real, not hypothetical.
It's not a simulation.
Not at all. Second, money is actively on the line. And crucially, that amount feels significant enough to trigger a visceral reaction.
Mm-hmm.
And third, and this is the psychological key, the outcome feels acutely personal. The financial movement isn't just data on a screen anymore. It's happening to you, threatening your capital.
Right.
That transition from a statistical event to a personal threat is the psychological shift that unlocks the override.
So the goal of the override is not to make a better financial decision.
Yeah.
The goal is just to resolve the immediate psychological discomfort that's caused by those three conditions coming together.
That's precisely right. The emotional brain is focused on immediate relief,
Yeah.
not long-term capital preservation. And to illustrate this, I think we should expand on your comparison.
To fitness routine.
Fitness routine, it's perfect.
Let's walk through that. So you're sitting in your kitchen on a Sunday, planning your week. You commit to exercising 4 days, eating whole foods, avoiding, say, certain high-sugar drinks.
That's great.
The plan is rational, sustainable, achievable. You're feeling strong, capable, focused on the long-term benefit.
It looks perfect on paper. Why? Because the immediate visceral pressure, the craving, the muscle fatigue, it's absent. You've planned for the perfect version of yourself.
But now let's fast forward. It's Thursday afternoon.
Mm-hmm.
You've had a terrible, stressful day at work. You're physically exhausted, you're mentally drained, and you walk past that coffee shop or the vending machine.
Yep, I know this feeling.
The rational plan says, you committed to this routine, hold firm, the long-term health is the priority.
But the immediate emotional pressure, the craving, the exhaustion, the desire for comfort, that urgent feeling that you deserve a break,
Yeah, you deserve it.
it pushes for a shortcut. It feels overwhelmingly urgent right now to abandon the plan for immediate relief.
That's it.
That immediate momentary comfort overrides the long-term commitment you made to yourself when you were calm.
And the same mechanism applies to finance. In trading, the stakes are concrete dollars, and the emotional override promises immediate relief from the pain of a loss.
Right.
Either the relief of selling immediately to stop the bleeding, or the relief of entering a rash trade to get back to even.
Yeah, and that's a big one.
This psychological urgency is often a far greater motivator than disciplined rule following. So, we have to recognize the strength of the plan is only as good as your defense system against it when you are under maximum emotional duress.
Exactly.
So how fundamentally do emotions manage to short-circuit a system that we know is objectively superior? Let's look closer at the exact mechanics of this override in the decision-making process.
It's crucial to understand that emotions act as triggers. They don't act as instructions that replace the logic entirely.
Okay, that's an important distinction.
It is. They don't erase the trading rules from your memory. They simply override them by supplying a false narrative of urgency.
A false narrative.
Yeah, the rule, the stop loss, the target price, the position size limit, it's still there in your head. But the emotional urgency provides a stronger, temporary pathway to action, one that bypasses critical thinking.
I want to challenge that slightly. If the rule is still accessible, why does the panicked executor choose the expensive destructive action?
Because the emotional brain is exceptionally good at manufacturing immediate, convincing rationalizations.
Ah, it tells itself a story.
A very convincing story. It's not that the trader forgets their stop losses at 10%. It's that the feeling of panic is so intense that they hit the button at a 20% loss instead.
And the brain immediately justifies it.
Instantly. There's an internal monologue. I had to do it. The market was crashing faster than I thought. Or if I waited for the 10% line, I might have lost everything. The brain provides immediate justification for the shortcut.
That makes perfect sense. The core conflict lives in the time difference between speed and reflection.
Yes.
Rules demand slowing down, reflection, adherence to objective criteria, a process that takes time. Emotions, especially those driven by fear or greed or frustration, they push for fast, immediate action, a process that takes milliseconds.
And that conflict zone, that moment where speed wins over reflection, is precisely where the maximum financial damage occurs.
So the faster the reaction, the more likely it's an emotional one.
The faster the reaction time between the stimulus, say a price move, and the action hitting the button, the more likely the emotional pathway has completely taken over.
Let's focus on that subjective urgency. In the moment of pressure, the emotional decision feels profoundly, deeply convincing.
It does. It carries a powerful, almost chemical promise of relief.
The market is moving quickly, and that internal voice just screams, if I don't act right now, I will miss this recovery, or on the other side, if I wait one more second, this tiny loss will turn into a catastrophe I cannot recover from.
And that urgency blinds the trader to the long-term consequences. The quick fix, the rash adjustment, the immediate entry, all of it offers a brief, fleeting moment of feeling in control.
When in reality, control has been totally surrendered.
Entirely surrendered to the immediate emotional state. It's an attempt to buy relief from psychological discomfort, but at a very, very high price.
Which brings us back to the hindsight paradox. Once the emotional charge passes, the trade is closed, the money is lost, the decision looks obviously and painfully wrong. The trader looks at the results and thinks, why was I so certain I had to do that? That was obviously the wrong choice.
And the ability to identify this temporary urgency, to recognize that the intense emotional state is fleeting, but the consequence of the action is permanent, that is the most important skill in containment.
So you have to know it's coming.
You must pre-program yourself to know that when you feel that white-hot urgency, you are at maximum risk of overriding the plan. That feeling itself is your primary warning sign.
It's recognizing that the calm planner brain that made the rule is fundamentally smarter than the panicked executor brain that is currently screaming for immediate action.
Yes.
The battle is internal, and the key is to give the smart brain time to catch up. We know this override happens generally, but let's look closer at the four most common emotional triggers that cause people to abandon their rules.
Good idea.
This is where recognizing the pattern helps you anticipate the danger before it happens. Because if you can name the feeling, you can start to deal with it rather than, being possessed by it.
These are predictable psychological traps. They exploit the inherent risks and the leverage available in the high-stakes environment of trading. Let's break down the personality of each destructive impulse.
Okay, let's start with FOMO, Fear of missing out.
Mm-hmm.
This is that pervasive modern feeling that the market is exploding. Your friends, your peers, financial news, they're all talking about some huge generational move.
And you're not in it.
And you're sitting on the sidelines watching it all happen without you. It's an intensely isolating and uncomfortable feeling.
And FOMO is defined by entering trades that were not planned. It's because the trader feels late or excluded from a major market movement. The fundamental breakdown here is a violation of the entry signal criteria. As the calm planner, you spent time defining exactly what conditions must be met for you to enter safely.
But the override action is that powerful urge to act now. The internal monologue insists, it's too late if I wait for the signal.
Right, I'll miss it.
That urgency bypasses the objective rule to wait for a specific, verified entry. You jump in simply because the price is moving fast, often driven by the desire to avoid the future regret of having missed the opportunity.
And this almost always leads to a terrible entry point.
Always.
The emotional impulse is always slow to arrive.
Mm.
By the time FOMO fully kicks in and compels you to act, the market has usually moved substantially. You often end up buying right near the peak or selling right near the low, only to watch the price immediately reverse.
So patience is the rule, but FOMO is all about impatience.
It is intrinsically impatient and sacrifices objective criteria for the subjective relief of simply being in the action.
It's the difference between waiting for the starting gun at a race versus, jumping over the barriers onto the track mid-race because you don't want to see the runners get too far ahead.
That's a great image. Your timing is terrible, but that feeling of exclusion is temporarily relieved. This is the greed-driven override, the inability to accept that not every move is yours to capture.
Okay, what's next?
Next is the most overtly destructive pattern: revenge trading.
Oh, this one's dangerous.
Very. This occurs immediately following a distinct, usually painful loss. The initial loss itself is usually manageable. The problem is the psychological shift it causes.
The anger.
The immediate shift to anger and self-justification. The primary objective shifts entirely. It goes from disciplined, objective rule following, and managing risk
to the overwhelming emotional goal of winning money back quickly.
Yes. The trader feels personally attacked by the market that took their money, and they need to recover what is rightfully theirs.
And this fixation on immediate recovery is dangerous because it leads to a complete intentional abandonment of all predefined risk parameters.
All of them. The override action is usually rushed, poorly researched decisions, often involving taking on position sizes far larger than initially permitted.
And completely ignoring money management rules.
Completely. If the plan dictates a maximum daily loss of $500 and a maximum position risk of 1%, the revenge trader might try to recover that $500 loss with a single trade that risks $2,000.
Wow.
Or they'll use excessive leverage they would never usually touch. The emotional calculus has changed.
Right. You're no longer risking new capital. You are risking stolen capital in your mind.
Exactly. And this leads to a compounding of the mistake. One manageable loss is frequently followed by 3 or 4 increasingly large, destructive losses as the trader digs themselves into a deeper and deeper hole.
All while pursuing the impossible goal of fixing the initial setback instantly. It is a complete abandonment of limits driven by ego and rage.
The irony is just crushing. The rule-following mechanism is designed precisely to absorb small, controlled losses as the necessary cost of doing business.
Right, it's a planned expense.
It is. Revenge trading attempts to eliminate that necessary cost entirely and instead turns a routine expense into a catastrophic expenditure simply because the trader felt personally affronted by the initial downturn.
It is the definition of letting a small wound become a fatal one.
Perfectly said.
Okay, so after revenge, we have fear.
Yes, and fear is tricky because it overrides rules in 2 opposite yet equally damaging directions.
How so?
At its core, it's the psychological discomfort of sitting in a volatile, open trade or the dread of realizing unnecessary loss. It's the desire to make the emotional pain stop immediately.
Okay, let's look at the first direction, the early exit.
Right, so the rule might define a specific target profit where you should sell half your position, but when the price hits 50% of that target, the volatility increases. The price dips back slightly, then it recovers, then dips again.
And you feel that discomfort of watching paper profits evaporate.
Acutely. And that fear overrides the rule to hold for the target. They exit too soon to gain immediate psychological relief, thus crippling the profit potential of a statistically strong trade.
So you sacrifice maximum planned gain for guaranteed immediate comfort.
Yes. You're so eager to secure some profit that you cut the trade short, violating the profit-taking mechanism built by the calm planner.
And this is a crucial element of profitability. If your losses are contained but your wins are always cut short by fear, you can never achieve overall consistency.
Never. Now, the other direction is hesitation, which is fueled by the fear of confirming failure.
Okay.
This happens when the rules clearly dictate action, like executing a required stop loss when the price hits your maximum risk level. Fear causes the trader to freeze.
They just watch it.
They hesitate, hoping for a minor bounce back, rationalizing that it will just take a moment to recover. The market will respect this level. This hesitation overrides the clear, objective rule to execute the stop loss immediately.
And that delay turns a small, manageable 1% loss into a larger, potentially devastating 5 or 10% loss.
Yes, it's the dread of confirming the failure that keeps the trader frozen, unable to perform the one action selling that would prevent the outcome they fear most.
And this is often made worse by volatility risk, right? If the price is moving fast, that speed feels like the company is fundamentally collapsing.
Absolutely, even if it's just short-term market noise. The inability to distinguish between market noise and genuine business risk is what amplifies the fear override.
So they mistake temporary volatility for a fundamental business failure.
Precisely. And the emotional trigger panic tells them to wait and hope, which is the absolute antithesis of a disciplined stop-loss rule.
Okay, so what's the last one?
Finally, we have the positive emotion that turns destructive. Overconfidence.
The hot hand.
The hot hand. This follows a period of notable success, maybe 5 or 6 winning trades in a row, where the trader feels a distinct sense of safety or invulnerability.
They start to believe their judgment, their intuition, is now superior to their own established written rules.
And this is a silent killer, because it doesn't feel like panic or fear. It feels like justified empowerment.
Right. The internal monologue is, I've been right 6 times in a row, so I clearly understand this market better than my generic rules do. I'm an exception.
Exactly. And the override action here is the blatant disregard of position size limits.
So they go bigger.
Way bigger. The rules state you must only risk, say, 1% of your capital per trade, because that ensures survival during inevitable losing streaks. The overconfident trader decides, this setup is perfect. I'm going to risk 5% or 10% because I know it will work. They increase their exposure wildly beyond what the planned rules allow.
And this might work once or twice, right? Which just reinforces the false confidence.
It does. They win big, and that reinforces the belief that breaking the rules leads to better outcomes. This is the moment the calm planner system is fatally undermined.
Because the system was designed to protect the capital base during the inevitable losing streak, which always comes.
Always. By ignoring those limits, they are setting up a catastrophic loss when volatility inevitably returns or their streak ends. A single, oversized position trade that goes wrong can easily erase weeks or months of successful, disciplined gains.
Because the psychological guardrails have been completely removed.
Right. And here's where, the integration of security concepts comes in. Sometimes overconfidence is silently amplified by a misunderstanding of market safety nets.
Like the SIPC or the FDIC.
Exactly. If the beginner believes, incorrectly, that those organizations somehow protect them from market loss, they feel an additional false layer of invulnerability.
They forget that the SIPC only protects against broker failure, not against market movement.
Right. And that subtle misconception reduces the perceived stakes, making the overconfident leap of risking 10% feel safer than it actually is.
So the key takeaway across all 4 patterns, FOMO, revenge, fear, and overconfidence, is that the emotional decision feels urgently convincing at the moment of pressure. And we have to accept that this feeling of urgency is deceptive, it's temporary, and it's the primary mechanism for financial damage.
It is a psychological illusion designed to make you act rashly.
This episode is sponsored by TrendlineGala.com. Quiz your way to financial mastery.
Now that we've detailed the threat, we really need to talk about the defense, and we must emphasize a core truth. Emotions are not the enemy.
Right.
They are inherent to being human, and they are amplified when real money is involved. Trying to eliminate them entirely is an impossible and, frankly, counterproductive task.
You cannot suppress them. Telling yourself, I will not feel fear, is useless when the market drops 10% in 5 minutes.
Of course not.
The feeling is going to be there, and trying to stuff it down only makes it burst out later in a more destructive way.
That's why the core principle here is containment, not suppression or control.
Okay, containment. What's the difference?
If you cannot control the feeling, you must control the action, that follows the feeling. Containment means deliberately creating space.
A buffer.
A psychological and temporal buffer, yes. Between the strong emotion and the final decision to execute the trade or break the rule, you are inserting a mandatory delay.
I appreciate that emphasis. Trading rules are strongest when market activity and emotions are low.
Right.
They are truly tested when emotions are high. That required space is the critical difference between letting the emotion pass harmlessly and letting the emotion dictate a destructive, irreversible action.
And understanding exactly how emotions bypass your rules is the first step, but containment is the necessary second step. It allows disciplined traders to stop damage before it grows exponentially.
So if you can anticipate the feeling, you can pre-plan the counteraction.
Exactly. And that counteraction should always be something physical or procedural that forces a complete slowing down of the decision process.
It's an automatic safety switch.
That's a great way to think of it.
So, if we're aiming for containment, here is the most important containment rule. It's designed specifically to shatter that immediate, damaging action-reaction cycle. This is the single most critical move you can pre-program into your routine, especially if you struggle with revenge trading or hesitation.
And the rule is simple, it's non-negotiable, and it must be executed immediately.
Which is?
After a loss, stop trading and pause.
Simple to say, yes, but devastatingly difficult to execute when that revenge trading impulse or that panicked urge to fix it now is screaming in your ear.
It is.
Let's break down the mechanics of the pause. Why does stopping trading immediately after a loss create such powerful protection?
Stopping creates necessary distance, and distance provides perspective.
Okay.
When a loss occurs, it instantly triggers a complex cocktail of negative emotions. Frustration, panic, the urge for revenge, deep self-doubt. These emotions require immediate action. You feel a chemical need to click something to resolve the pain. The pause, which could be a mandatory 10 minutes, or stepping away from the screen for the rest of the day, shuts down that immediate feedback loop.
So it's the mechanism that prevents one singular calculated mistake or loss from turning into a destructive chain of losses driven purely by emotion.
Yes. You are physically removing the tool of destruction.
That's a powerful way to put it.
If the trading platform is shut down, if the keyboard is pushed away, the override cannot be executed. You cannot revenge trade if you physically cannot access the execution button.
And that distance allows the rational part of the brain, the calm planner, to reassert itself.
It does, once the initial emotional charge begins to fade. It requires patience, but it preserves capital.
Let's talk about implementation, because just thinking, I will pause, isn't enough. What physical steps make the pause work effectively?
Implementation must be procedural and automatic. When the stop loss is triggered, or the planned loss limit for the trade is hit, the immediate step should be, first, log off the trading platform completely.
Not minimize, not close the chart.
No, log off. Second, stand up and physically relocate yourself away from the screen. Even a 10-foot walk to the kitchen is enough to break the trance.
Okay.
And third, review a pre-written post-loss checklist.
What's on that checklist? Is it about the market?
No, it's not about analyzing the market. It's about self-assessment. It should contain questions like, did I follow my entry rules? Did I execute the stop loss? What emotion am I currently feeling?
And you have to name it.
Name it. Anger, frustration, fear. The act of naming the emotion and answering the questions forces cognitive load back onto the rational brain and away from the impulsive brain.
That turns a white-hot emotional moment into a cold procedural review, which is fantastic.
It is.
Let's use some everyday relatable scenarios to illustrate why pauses work in these moments of perceived urgency. What about stepping away from a frustrating home repair mistake?
Oh, that's highly relevant.
Yeah.
You're trying to install a new light fixture or a shelf, you drill the wrong hole, you strip a screw.
And you feel that immediate anger.
And suddenly, you feel this overwhelming urge to just force the solution. Grab a bigger tool, rush the measurements, hurry the rest of the job because you're mad at the wall or the tool or yourself.
And that rushed fix usually causes more damage, cracking the plaster, permanently ruining a piece of hardware.
Right, or requiring an expensive specialist later. The smart, disciplined response is to put the tool down, walk away, make a cup of coffee, and only come back when the frustration has dissipated.
And then you can calmly assess the damage and find the correct solution.
The solution was always available, but the frustration blinded you to it.
Or what about that intense frustration with a complex computer program? You're working on a huge spreadsheet or piece of code, and the program crashes, losing a chunk of work.
We've all been there. You feel that immediate hot flash of annoyance, and the instinct is to wildly click every button, restart the entire system immediately, or, bang on the keyboard.
All driven by the need to resolve the crisis right now.
But the calm approach is to take a breath, close the application, verify that the autosave captured the work, and then methodically attempt the restart based on a logical sequence.
The pause prevents that rash, button-clicking action that often leads to losing even more work or creating new errors in your system.
And in trading, this pause is the ultimate calculated control mechanism. It is not a sign of weakness or failure.
It's a sign of strength.
It's a sign of immense, mature discipline. You are proactively choosing to save your capital base from your own emotional state. When you implement the rule after a loss, your trading day is over. You are turning an impulse into a procedural boundary that cannot be crossed.
You have stopped the momentum of the emotional override before it can compound.
And that is a habit that will pay dividends far greater than any single prediction or piece of market research ever could. The greatest risk management tool you have is your commitment to your own pre-planned boundaries.
So, wrapping up our discussion today, the core message is clear. You will never eliminate emotion from trading, but you can absolutely contain it. The mechanism of the emotional override is a powerful temporary force that promises quick solutions but delivers compounded damage.
And your most crucial defense isn't better forecasting, it's the pause. By implementing the strict rule to stop trading immediately after a loss, you turn a moment of temporary destructive urgency into a planned, rational stop.
This is how you protect your long-term consistency from short-term emotional pressure.
Absolutely.
If you're a beginner and want to practice recognizing these moments safely, you can take our free beginner trading quizzes at trendlinegala.com and learn how rules and emotions interact.
Next time, we'll talk about how to choose tools and platforms without getting distracted by features that don't really help.
Thanks for joining us at Trendline Gala.